talked about this a lot, if we can, and that's about how unemployment's bad. It's like when people say markets inventories are low, that's usually a sign that the commodity prices have peaked. And what I show you in this screen is this is just, it'll come up in a second, Scott, if you can bring it up. The unemployment level in the US is bottoming from the lowest level in about 50 years. And I just overlay that every single time it does. This is the lowest level since we go back to 1969. What happened? Oh, we had a pretty significant recession. Unemployment bottoms, significant recession. Unemployment bottoms, recession. Unemployment bottoms, recession. Unemployment bottoms. It's bottom. It's the stated goal of the Fed to reduce inflation, unemployment, and making that go up is part of that deal. It's just inevitable. So to me, this is how macro and big picture we are right now.
U.S. inflation is currently showing a much slower pace compared to the red-hot speed observed last summer. However, it's not assured that it will naturally decrease to the Federal Reserve's targeted 2% rate without a significant rise in unemployment. The likelihood of a soft landing scenario, where inflation is tamed without causing widespread job losses, has always been the Federal Reserve's primary goal, as stated by Fed Chair Jerome Powell last week. Yet, there are numerous uncertainties and economic challenges on the horizon, including banks tightening their lending standards and the imminent resumption of student loan payments, which is just a few weeks away. Even Powell himself expressed some doubt about the possibility of a soft landing during his remarks last Wednesday when the Fed officials voted to keep interest rates stable at a 22-year high. With the housing market weakening and stock markets remaining uncertain, China's working and middle class is increasingly turning to one investment option that is regaining popularity: gold. For Chinese consumers with limited access to overseas investment opportunities, precious metals like gold are among the few avenues available to counter the devaluation of their other assets. Given that the yuan is expected to weaken further, most Chinese individuals cannot easily acquire US dollars or US dollar-denominated products to hedge against the depreciation of their currency. Mike McGlone delves into the gold frenzy, explaining why gold remains the preferred choice for people in situations like those faced by individuals living in China. Additionally, he attempts to draw comparisons between Bitcoin and gold in their roles as havens during times of economic uncertainty. Now, let's move into the video.
Please take a moment to like this video, subscribe to the channel, and don't forget to drop your comment and observations in the comment section below. Thanks and enjoy the video.
The average price for gold this year is the highest ever. Tell me another major asset you can say that about. And the key thing is that's pressuring gold recently is the stock market's had this big pump, and you can get 5.1% in a 2-year note, and gold yields nothing. That's been a pressure factor for Bitcoin too. But you did mention the key facts. One of the most significant facts is ETF holdings of gold. That's mostly investors have been down about 10% this year. That's quite significant with the gold price up. That's basically never happened. So it's showing divergent strength. It's like it should. I think gold's going to be one of the best performing assets. And it's a question of what's going to take for the catalyst to spark. It needs probably for the Fed to pivot, a sign for that potentially to pivot, the recession to kick in, no longer being able to see how I can get average annual 9% on the S&P 500 in the next few years. And I think gold will break off. To me, that's a breakout. It's a matter of time. So that Fed pivot's probably going to come from just what you see in the screens this morning, a little more weakness in the stock market. So I think gold and the stock market, S&P 500, are going to meet about 3,000. S&P 500 around 3,000, gold around 3,000. I know that's going to tweak Dave. I love when I tweak Dave, and maybe James too, but I can show you that. I'll be publishing on that tomorrow, and it's just pointing out that historic relationship between the two. And a key thing I want to point out in the simple facts of what I will be publishing in the macro big, first the smaller big picture is what we've been watching the last few weeks, just waiting for the Fed to I'll just show this on my screen if I can, show for the Fed to finally take out, if you can share it, finally take out this hiking. It's right there. It still shows hiking. This is a WIRP screen. Shows the Fed still is about 20% they're going to hike at the next two meetings, November, December. But this level here, but 5.37% compared to the Fed rate of 5.33, was as high as 5.45. That's finally inching out. That's the first baby step. And the only way to take that out, I think, is the stock market to go down. That's happening. That's where you might see that pivot towards gold, but it's so early days. We still have to get to the market, still price for all this easing. And Fed says they're not going to ease. Market thinks it's going to ease, but the stock market has to make it ease. That's your pivot, and I think that's what you're kind of seeing from weakness in stock market, weakness in Bitcoin, and specifically copper. Copper's breaking down this morning too, and that has been a good leading indicator for years.
The surge in interest has propelled spot gold prices in China to their highest point in 13 years, causing the gap between domestic and international gold prices to widen to its greatest extent in a decade. As of Monday, the spot gold price stood at more than 445 yuan, equivalent to $61 per gram, resulting in a disparity of approximately 4.7% between the gold prices within China and the global market. In mid-September, the retail price for gold from reputable brands like Showtime, Sang, and China Gold had already climbed to 600 yuan per gram, but buyers remained undeterred. McGlone continues with his Bitcoin projections and stance, reiterating that Bitcoin remains the top risk asset. However, with the impending stock market crash and a looming recession, he doesn't foresee it performing exceptionally well in the short term. Let's delve back into the discussion.
Bitcoin's a 50 vol asset. It's the best performer asset in the history of mankind. And everybody's bullish, as you see, and most sentiment. And also, if you remember when the financial crisis hit, gold was a 20 vol asset and still dropped 30% from 1,000 to 700, and then it went up to 1,900. That, to me, is when you have a volatility asset that's 2 to 3, 4 times a typical vol asset. When people hit stops, it doesn't go up. Maybe we'll get lucky, but that's going to happen to me. That's the next bridge. If I can share a screen, I'll show you where I think things are going. And just a simplistic measure of you take the per ounce price of gold, which I show you there in orange, and you put that in the same scale as S&P 500. Every time we have a recession, if the gold is below the S&P 500, it takes off. If it's above it, it goes down. This has been since, we came off the gold standard in 71. So we got 50 years of history here. Right now, the S&P 500 is very expensive at 4,300. Gold's very cheap. For a recession, then I just show that in the bottom, that leading indicators has a 100% chance of predicting recessions when it's minus 7.6%. For the last 100 years is showing recession. So we're going to get it. It's just a matter of time. And then one thing was put in the shorter term. One thing I love about the macro in terms of the S&P 500 is if you can take it, S&P 500, divide by 1,000, you have the same price of copper. And that's what I show you here. In white, it's copper. S&P in orange, it's the S&P 500. Got a little expensive. And and that's the 10-year yield in gray. I mean, they're all on the same scale, and they're all heading lower in a recession. So to me, that's the key thing to remember is we might be able to avoid this recession, but it's almost inevitable now because what's happened since we had that pendulum swing from, it's going to be, the whole world said it's going to recession, and then the whole world said we're not going to have a recession. And now what's happened this year when we tilted back is the Fed's raised another 100 basis points. So to me, this is the key thing to think about with risk assets. And the number one factor is that U.S. government two-year note. It's just oppressive. Right now, the yield, the dividend yield on the S&P 500 below versus a two-year note is about 370 basis points below. That's the cheapest, lowest dividend yield versus the two-year note versus Fed funds since 2001. And here's one final chart I got to show you, and then I'll stop annoying with charts, because this to me is the most significant thing. That's a Warren Buffett model. Takes a little time to load. It's what everybody has forgotten, is that if you just take the S&P 500 and you divide it by U.S. GDP, just take that GDP in trillions times 100, and you have the S&P 500. That's what I show you here for 90 years. It's the most expensive now. The S&P 500 versus GDP, same scale, implies that S&P 500 should go to 3,000. And that peak last year was the highest in 90 years. And what's really changed? Easy money, WIRP, the ZIRP. I'm sorry, zero interest rates are gone. It's reversed. And that to me is what's happening now. It's in the early stages. And if for this to stop reverting, we need rates to go down fast, or the dollar to go down fast. And what's it going to take for that? The dollar's breaking the global economy. The stock market probably has to just revert to this long-term relationship with GDP, unless we've reached a new higher, permanently higher plateau, which would be wonderful for everybody. I'm not the doom and gloomer. I'm just pointing out facts, evaluation in history. And typically, one thing we need to remember is Bitcoin was born in this area of zero interest rates. We had no choice, ZIRP. Now we do. That U.S. government two-year note gives you 10% in 2 years.
1 year ago, a borrowed money bubble near the fringes of the UK bond markets imploded with such force that it could have ousted a prime minister and prompted the Bank of England to undertake an emergency rescue operation. Now, the world's most influential regulators are intensifying their scrutiny of the mounting potential risks within the bond market, especially the much larger $25 trillion U.S. government bond market. In the past month, both the Bank for International Settlements, a central bank coordinating body, and the U.S. Federal Reserve have drawn attention to a swift accumulation of hedge fund bets in the Treasury market, particularly in the so-called basis trade. This basis trade involves playing two nearly identical debt prices against each other, entailing the sale of futures and the purchase of bonds to extract gains from the slight gap between the two using borrowed funds. While the participants and the specifics of this strategy differ from those involved in the UK's liability-driven investment crisis of the previous year, they share a common characteristic: the collision of substantial leverage with sudden and unforeseen market movements, capable of swiftly causing potentially significant problems. The exact scale of the basis trade is challenging to ascertain, with the Federal Reserve itself lacking precise data. However, leveraged fund short positions in the most liquid futures contracts reached an all-time high of nearly $900 billion in late August, according to data from the Commodity Futures Trading Commission. Such risks are crucial because the U.S. Treasury market serves as the bedrock of the global financial system. The yield on U.S. government debt is the so-called risk-free rate, and serves as the benchmark for every asset class. The short yet devastating crisis in the UK market a year ago underscored how rapidly markets can descend into disorderliness when leverage is employed, presenting an increasingly pressing concern for regulators focusing on potential problems that have accrued over more than a decade of ultra-low interest rates. What are your thoughts on the gold rush occurring in China and the looming recession in the US? Feel free to share your comments below. For more Daily Dose Crypto news, check out these two awesome videos on your screen. Click now and we will see you on the next video.